Guys, the market has been a seesaw this year. This is the S&P 500, this SPY, the ETF. Down, up, down, up, down, up, down, up, down. This is what happens when markets are in a correction phase. Now, I say correction kind of loosely. My personal belief, if you've watched this channel before, is you'll remember this. Markets are still very much overpriced. I keep seeing all these pundits saying, oh, we're going to hit a low soon, or we've already hit a low. I don't think we're anywhere close to the low. And let me show you why. So this is my sheet that I created on the stock market to GDP ratio. Warren Buffett considers this the most reliable metric at any given time on where values stand. Currently, the S&P is at 3980, and we're currently, according to history, 67% overvalued for a fair value of 2384. Now, in history, when we're overvalued by over 30%, our 10-year return on average is a minus 0.1%, not including dividends. So you might be looking at this going, well, why the heck would I put any money in the market? Well, let me show you why. Let's go back a few years. The market's been overpriced since March of 2013. And let's say you said, you know what? I'm not putting the money in if it's overpriced. The S&P at that point was at 1570. Since then, GDP has gotten higher and higher and higher, and the market has gone more and more overpriced. But look at it now. Fair value is 2384. So if you stopped investing at 1530 or 1550 or whatever it was, you'd have missed out on a 50% gain, over 50% gain, just in terms of the intrinsic fair value of the stock market. Your job is to not guess where the market's going. Your job for most of your money going to retirement is to dollar cost average every single month, month in, month out, quarter in, quarter out, whatever you decide to do. But because you can never guess what's going to happen. Look at last week. Last week, CPI came in at 7.7%. Everybody was excited. NASDAQ went up 7%, S&P up 6%. Last week was a huge gain for the markets. Imagine if you'd missed that just because you were trying to wait it out. Now, you might be looking at me and saying, well, Paul, you've said time and time again that you're waiting for the markets to go down. My situation is extremely different, and I repeat this over and over. Don't mimic my investing style. I have 8 or 9 businesses upstairs. I have hundreds of apartment units. I have options. I have so many different levels of cash flow that it does not matter to me to be, what matters most to me is have my money invested in deals for the long run that make the most sense. Now, with that said, look at Alibaba and Meta. These are 2 companies I own, and I've bought into them as they went down. Am I worried that they're down 40%? I'm like, no, not at all. And that's my point. I can do those things and not worry about that, while you might be saving for retirement and you have to sit there and make sure you're invested day in, day out. Because 2013 is 9 years of overpriced market. Even if you waited till the market was 30% overpriced. Look at this, 2275, you would have stopped, and the market's still currently higher than that value in terms of fair value. And my guess is this fair value is going to keep increasing. You know why? Because it's based on GDP. And this is one of the benefits of inflation right now. With inflation, nominal GDP is going to keep going up and up and up. Let me show you. In 2015, call it, GDP was 18 trillion. Let's go 5 years later, 21.7 trillion. That's a $3.7 trillion increase. Now let's look at the end of 2020 to now, a $4 trillion increase. Why? Because of inflation. We saw that big jump because of inflation. If we had 7% inflation for the next 10 years, that would take GDP from 25.6 to $51.2 trillion. And at that level, this market is massively undervalued at current levels. And that's the point. We don't know where inflation will be in the next 10 years or in the next 2 years, next 1 year. Please stop listening to people who claim they know. They have no idea. But what I want you to do is, one, this makes sense to you, subscribe to our channel. Because I'm not sitting here trying to guess the future. What I am trying to do is sit there and say, based on where we are today versus where fair value is, what does it mean for the future of the stock market? It's probably not going to be great for the next 10 years. But the one thing I encourage you to do is, even if I'm right on this and stocks go like this for the next 10 years, you can still make money in a sideways market. How? Dollar cost averaging. Because if you dollar cost along the way, you're going to average paying that much. So overall, you're still going to make the spread while the market is flat. And that's the key to all of this. I don't want you trying to guess the markets. You're going to miss out on the biggest days in market history just by sitting there and being patient. Now, if you want 10 or 20% of your money to sit on the sidelines just waiting for the right opportunity, more power to you. But please, I still want you to focus on using our retirement calculator to figure out, are you on track for your retirement savings? If you are, with your 80% invested in ETFs, then do whatever you want with the other 10 or 20%. But don't avoid the path to retirement. That is going to hurt you much more in the long run than trying to worry about stocks going down 5%, up 10%, down 20% in the short run. We are here, and I'm here to teach the emotional aspect of investing, because more than the numbers, that's what matters most. Dollar cost averaging has nothing to do with numbers. It's just be a robot. And guess what, guys? I have found in investing that the more robotic you are, the better you'll do. The less emotion you input into your investing, the better you'll do in the long run. Now, does that mean avoid buying individual stocks? No, of course not. All the more reason to if you can control your emotions. That's what I'm doing. I have a list of 15 or 20 companies that I want to own in the long run. I currently own 2 of them, and that's it. I want to keep building this portfolio of great companies, but I got to wait for the right prices. And again, I repeat, I have several sources of cash flow and net worth growth. I don't need to be in the market. That's why I can be a lot more patient. I'm by no means Warren Buffett in terms of my wealth, but look at Warren Buffett. He has $100+ billion in cash laying around waiting for the right opportunities. And again, I'm not saying I'm Warren Buffett, but what I'm saying is if you're trying to save for retirement and you need to save for retirement, dollar cost average. Every month, every quarter, whatever you choose to do, dollar cost average, you will do very well. But in the meantime, in the next 10 years, based on this data, it will be a tough 10 years, but you can still make money by doing what I said in a sideways market. It's absolutely possible as long as you stick to a plan that works. That's simple. So if you're following all of that, awesome. You're doing great, but you probably want to do a little bit more, and I don't blame you, buying individual stocks. So here's what I commend you on. If you're watching this video right now with the market down 15, 20, and the NASDAQ down 30%, and you're still interested in individual stocks, that's great. Now, what I recommend you doing is this. Go pick stocks you want. Let's pick one, for example, Microsoft. Now, here's an example, by the way, that I haven't brought up yet. Microsoft is an example of a company that, because I was waiting to get in and out based on how overpriced it was, I missed out on massive growth. I bought Microsoft at $22, $23 a share 10 or 11 years ago. At $60 a share, I said, this thing is massively overpriced. I'm selling it. And guess what? It went to $350 a share. It's currently at $240, and I'm going to show you what the value is on Microsoft based on our 8 pillars. So guys, Microsoft is great, has great 8 pillars, but of course, the main thing here is PE and price of free cash flow over the last 5 years is way too high. And guys, it makes perfect sense. The more you pay for something, the less your return is going to be. That's simple. The future is going to be what it's going to be. The company is going to generate whatever cash flow to generate. So the more you pay for that today, the worse you'll do. But don't forget, you'll never get the bottom correct. So stop worrying about getting the bottom correct. No successful investor in the world has ever worried about, did I get the bottom? In my entire 20-some year career of investing, I've gotten the bottom on a stock one time by complete dumb luck. We're talking about hundreds and hundreds of transactions. I've gotten the bottom once. And by the way, I'm not even convinced it's the bottom yet, because it was Southwest Airlines back in the 2020 crash. It could still go below that. So we're not even out of the clear that it could be the bottom. But the point is, I've only gotten it once if that proves to be the issue. So let's look at analyst estimates for Microsoft. Look at this EPS growth. Man, that's still solid for such a large company. They're going to double their EPS according to analysts over the next 5 years. Now remember, analysts tend to be a little bit more aggressive and optimistic. Let's look at revenue growth. Again, low double-digit revenue growth every year. Pretty solid. So let's translate that into our stock analyzer tool. All right, guys, so I'm going to do a 10-year analysis on Microsoft. And I'm going to use some of these assumptions the analysts have made for my assumptions here. The first line being revenue growth. In the last 10 years, they've done 10% a year. Recently, 15 and 15% over the last 5 and 1 years. So I'm going to go on the high side and call it 10% because the 5 or 6 year estimate was 10% a year. So I'm going to sit there and assume 10% on the high side. Middle, 7, low side, 4. Guys, I have a hard time believing Microsoft will hit 4% revenue growth in the next 10 years. But my job is to be conservative. I still want to be conservative in this regard. Now, profit margin. The profit margin, as you see, has gotten better over time. So I'm going to go with, let's say things get tight, 21, 28, 31, and 34. Just basically what they put over here. I'm just sitting there saying, listen, cloud computing is better. They're doing the subscription software now. It's getting a lot. Margins will probably get better as time goes on. And they'll probably get smarter about their efficiency of running during a slowdown in the economy. Free cash flow margin, I mimic that exactly. Even though their free cash flow has not been as high in the last year as their profit margin. But let's still go crazy on the high side. Now, PE and price to free cash flow. Where will the PE and price to free cash flow be in 10 years? Not today, okay? As Microsoft gets bigger, it's harder to grow. And one of the major factors for a higher PE is growth potential. If two companies are exactly the same, but one can grow 20% a year and one can grow 2% a year, I would much rather pay a higher multiple for 20% per year. Now, they do have a big moat, but I'm still going to be conservative and call it 14, 15, and 16 on the PE and the price of free cash flow. Not very big difference in them. It's Microsoft, the big conglomerate. I just don't see 20 happening. I don't see 12 happening. Could it? Absolutely. But our job is to make decisions based on the future overall. Now, for our final desired return, this is basically your margin of safety. The stock market will get 9 or 10% per year just by investing in a long-term ETF. So for your desired return, you should probably get a higher return. And as your assumptions get higher and higher, you should have a larger margin of safety, which means a higher desired return. Because the higher your return, the lower you pay for the stock, and vice versa. All right? So for here, I'm going to go with 12, 14, and 16% return. Now, the stock is currently at 240. I'm hitting the analyze button. Below will pop up 6 numbers. 3, a low, middle, and high based on earnings, and a low, middle, and high based on free cash flow. If they're all green, it doesn't mean go out and buy. It means verify all this. And the best way to do it is to join our community at everythingmoney.com. There are thousands of people in here that you can talk to about their assumptions to go out there and do the research. Okay, so the numbers are, so guys, look at this. A low price of 100, a high price of 155, a middle price of 130. I have it on my watch list at 195. This does not mean I'm buying it at 195. It means I'm going to start selling puts at lower prices. Now, what's the price? I've had as low as 150 here, as high as 180 here when running my numbers. This is part of the investing that's an art, not a science. Your job is to go sit there and determine what you want to pay for Microsoft. Thank you very much, guys, and don't forget to subscribe to the channel. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.